Thanks, Karim. Just by way of background, a little bit, I have, for a number of years, I've had a courtesy appointment on the faculty at San José State University, and it was in that capacity that I met up with Tom. We've been working on in areas like studies of video games. I have some involvement with the virtual reality lab there, and I'm also at the moment working with some people in the business school. When several months ago we had at Linqto, we felt that it would be a good idea to bring together some experts in the crypto space to have a conversation about what way things were going. And we had an attorney from Washington, a researcher who was very involved in the nitty-gritty of the crypto space, and also Tom, who I've been involved, especially in the education side of this topic. So, as Karim just said, the level of interest was quite high, and we thought that it would be helpful to give people a quick grounding in some of the basics of cryptocurrency and digital assets. And since Tom was heavily involved in that right now, this current semester at San José State, I thought he'd be a good candidate to share his thoughts with us. So, Tom, do you want to take it away?
Sure. So I had a couple of slides I was going to share at some point. Do you mind if I share at this point?
No problem.
Okay, so figuring I'd start off by talking a little bit about my background, which John already covered a lot, but then also some shameless plugs along the way, just to sort of get those out of the way at the beginning. Part of my background lately is I've been working with Zero Chain, which I think Saswata, the founder, spoke here maybe, was it 2 weeks ago?
Yes, he did.
Last week, yes. Yeah. Mm-hmm.
Last week, okay. So you probably know a lot about what they do. He's definitely been more on the business side, and I've been sort of in the background of all the technical designs. And then the other thing, my other position is that I am a professor at San Jose State, and I've created a brand new class in blockchains and cryptocurrencies. And I'm the kind of teacher who really likes to get my students in the weeds to really see how things work and tinker with the parts at a low level. So the way I did that is I've been creating a blockchain, the sort of a simplified version of Bitcoin. We're doing a bunch of experimentation with students. And why I think it might be of interest to some of the folks here is it's also a pretty good mechanism for doing things like you have a new design that you think would be a good one. You can rapidly build up a prototype and you kind of kick the tires of it a bit to see if it's actually going to work out or not. And if it's a failure, you get to fail cheaply before you invest a whole bunch of serious engineering resources into it. So with those shameless plugs out of the way, a few things. I have a couple of limitations as a speaker. One of them is I am a computer scientist who is used to primarily speaking to computer scientists. If I start saying things that don't sound like English, please let me know and ask questions. Again, I'm totally happy if the discussion goes in a different direction than what I have planned. I like questions. The other thing is I am notorious for speaking very quickly. And I've learned when I speak live, I have to look for that look of terror on a few of my students' faces to realize I need to take it down a gear or two. So if I start speaking too quickly, please let me know and I'll slow it down a bit. Okay, so the way I figured I'd kind of discuss things today is that I'll start with Bitcoin, kind of the pieces of its design and how it works and what's interesting about it. And then sort of move on from there to where does it not work so well? Or where has the landscape changed? So things that used to make sense and used to have sort of one vision of how things work really isn't true anymore. And then talk about a few areas where it kind of tapped into something that it didn't maybe quite realize the full potential, and that how other cryptocurrencies have really built off some of those concepts and ideas and really been able to take them to a much greater level. So again, please feel free to interrupt me anywhere along the way. Now, Bitcoin is distributed and decentralized. So those are two similar sounding things, but they mean something different. The distributed part isn't really that exciting. It just means it's running on a bunch of computers all over the world. So, you know, if something happens and a machine crashes, or even an extreme event like the World Trade Center ends up going down with a bunch of machines in it, still it's distributed geographically around the world. But what's really interesting about it is the decentralized part, meaning no single person is in control of it. In contrast to how we're used to dealing with finances, there's usually a bank involved somewhere, or an exchange, or somebody who's really in control of the situation. And the fascinating thing about Bitcoin is that nobody is really in control of it. No single party dominates how this works. Now, the three pieces that they developed that are sort of the things I think are most interesting about it for how they achieve this. The first is the blockchain. And then there's the way that they come to an agreement as to what's the valid state of the transactions on the network. And they've come to, that's been called Nakamoto consensus, named after the inventor. And then I think the third piece is this scripting language that they introduced as part of its design, giving it quite a bit of flexibility. So I'll try to cover each of those in a little bit of depth. So starting off with the blockchain, probably all of you have heard that idea before about what it's supposed to be, that we have these sort of collections of transactions detailing how money moves through the network. What's sort of interesting about it from a kind of technical perspective is that it's sort of an immutable ledger, meaning once something's in it, it really can't be undone. And so as it sort of builds up and continues along, you have this record that nobody can really tamper with or manipulate. And there's been some work out there trying to build off on that, and we'll come back to that a little bit more later. But when you hear about things like voting and how it's applied to the blockchain, it's this idea that once it's in the blockchain, you can add more stuff on top of it, but stuff that's already been written down, you can't change. To sort of use an analogy, it's kind of like you have a bunch of clay tablets, you know, where you think of like each block as a clay tablet that you write down, and once that tablet's baked, nobody can change it. And there's sort of this connection of you have more and more clay tablets that go all the way back to the first clay tablet written, and that gives you this long record of all the things that have happened. So that's one of the ideas that's, you know, value really a core of how Bitcoin works, and an idea that people have seen a lot of potential in for doing other interesting things. For the consensus part, there was a lot of work being done in the computer science research before Bitcoin as ways of trying to get everybody to come to an agreement on how things work. There was the first one I heard about was called Paxos, and it was ridiculously complicated, and everybody who tried to implement it got it wrong. And then somebody simplified it and they called it Raft. And it was ridiculously complicated, and everybody who tried to implement it got it wrong. And then in this space came Bitcoin, which had its own simple and elegant way of coming to an agreement on what the state of the system happened to be. And it's, you know, it's simple enough I can explain it to my students and my undergraduate students. It sort of lacks some of the academic purity that people like me like to see. You know, you don't get the same level of guarantees. Instead, you get this probabilistic guarantee. And you probably heard about Bitcoin produces blocks, and you wait till a certain number of blocks has been produced. And basically, every single block that gets produced sort of adds weight to all the ones that came before it. So as we go along, it's kind of go back to the clay tablet analogy. Those tablets get more and more solidified, and it's almost like they become unbreakable at a certain point. Now, in theory, it's possible that you know, if there happens to be some discrepancy, it usually gets resolved in, you know, pretty quickly. A couple of blocks in the Bitcoin world, that'd be like, you know, 10, 20 minutes if somebody happens to have some competition. In theory, though, it could roll all the way back to the very beginning. So that's sort of the lack of academic purity that give a real simplicity to how the implementation works and how the concept actually pans out.
So, Tom, if I could just clarify something. You mentioned the blocks being produced and
Mhm.
taking some time, and
Sure.
then there's a sort of a consensus about the status of those blocks across the network. How are they produced? What's the process
Yeah, so
there?
that's the process called you hear about the miners and what they're doing.
Ah,
And it's sort of the strange thing about what they're set up to do. So, as some analogy, because it's decentralized, it's kind of like a town hall meeting where if John, if I want to give you money, I go to the town hall meeting and I shout at the top of my lungs, "Hey, I'm giving $20 to John." And everybody's got a copy of the ledger. They open it up and say, "Okay, yeah, Tom has $20. We'll move 20 over from Tom's column to John's." Um, the trick is you don't want to have a bunch of ballot box stuffing or people taking advantage of that system. So the way it was designed, they use this analogy of what they call one CPU, one vote in the original paper. So basically, you kind of vote by your computer. Now, things have changed a little bit over time for how that works. But
So a couple of weeks, just to say, 5 of us, assuming we can be with.
Sorry, Danny, your audio went out. What was the last part of that?
I don't think that was intended for us.
Okay. So one of the analogies I've heard for explaining how it works is it's kind of like they all solve Sudoku puzzles. Has anybody heard that analogy before? Of miners solving Sudoku puzzles?
Yes.
I'll share my screen again for the sort of example. Probably many of you have already seen them, but let's see. My mom's a Sudoku addict, so she has these all over the place. I've never particularly played that much myself, but you've seen these puzzles, and the goal is to get the numbers 1 through 9 at every row and every column. And it's the thing that's interesting, that's why it makes a good analogy and why people refer to this is because it takes some time and effort to figure out a solution for a Sudoku puzzle. But once it's filled out, it's pretty easy to look at it and see that, yeah, this is the correct solution. Now, one of the things nice about it is, that's also a good analogy, if people start getting better and better at solving Sudoku puzzles, you can also just make the puzzles more complicated, and then it'll take that much more time to figure people out. And in Bitcoin's mechanism, it's really, really easy to scale back and forth. So, but that's sort of the key part of the process. When all these people mine, they're looking to solve these puzzles to find some answer that they can share with everybody else. And in fact, you can actually literally do this. I have one of my students for a class project. He is swapping out the proof mechanism Bitcoin uses for a Sudoku solver and implementing that. Now, while this analogy works great for sort of explaining how it works, I think it misses a big piece that people forget to explain, which is how exactly does solving a Sudoku puzzle or solving any kind of puzzle validate transactions? And the core idea there is that in some kind of way you have, you collect up as a miner a bunch of transactions and you put them together. This is what's going to be your block. And then from that, the transactions end up generating a puzzle. So you can think of it, like you collect these transactions together and it gives you a Sudoku puzzle that you have to solve. So you have to have some connection between those two. You can imagine like having a gigantic database of Sudoku puzzles nobody had ever solved. And you collect these transactions together, it crunches them down to a number, looks up that number of puzzle, and it gives it back to you to solve. What's really important about that is if somebody tries to go back later and change the numbers around. So, I was supposed to give, $20 to John, but instead they're going to change it to give $20 to Mike. Well, then the Sudoku puzzle is a different puzzle and it doesn't work anymore. I don't know, did that analogy make sense?
Yeah, I think just interpreting it as some amount of work has to be done to solve the puzzle is where the unit gets its value.
Yeah, and it's what prevents it from really rewriting history and changing things. And that's the whole idea of somehow you have to connect these transactions to this puzzle, and then you can actually try to easily verify it. And the other thing that makes it work is pure unfiltered greed. So the system is designed that if you're a miner, you could, if you have a lot of computational power, go back and rewrite history. But it's designed so that you'll make more money if you actually play according to the rules of the system. So because there's this new money that springs into existence by the way the rule works. So you get, if you solve this puzzle, you get a reward. And it's a better idea. It's more profitable for you to take that reward than to try to mess with the transaction history. And that's sort of the core idea of Bitcoin, is really making it so that you work with the system and you profit by it. Therefore, you don't really have to trust anybody to do anything other than do what is they should want to do based on their greedy behavior. Okay, so that's sort of my analogy for how mining works. Is that anybody have any questions on that part, or something that's still not quite clear? Okay. The other part that I thought was very interesting about how Bitcoin works is this scripting language that they introduced. And it doesn't sound like a whole lot, but basically means that you can actually put a variety of different financial setups available on the blockchain. So instead of just moving money from person A to person B, you could set something up where, you know, I could give money to John and Mike, or maybe I have a bunch of different pots of money that I could combine together into a big pot and give to somebody else. Or we can do things like maybe John and I both have to sign off that this particular pile of money is only to be spent if we both agree on it. So there was a variety of different schemes that are possible because of the scripting language they have. The challenge that they ran into is anytime these little scripts run, they run on every single computer in the mining network. And they all have to come to exactly the same solution. So there can't be anything that might throw things off or cause stuff to be a little bit different. So they created a very limited power for what this language could do, because they don't want to end up in any weird situations. They don't want to have the mining network crumble and halt because somebody wrote a bad script. And it gets even a little bit more limited because most of the miners actually just flat out don't take transactions if they aren't one of these 5 standard types. Now, you have to follow this template because we don't know what weird stuff you're doing otherwise. There was a paper a while back where somebody wanted to create something different, and they basically had to pay off one of the large mining pools to take their transaction for them and add it to the block. And once it's accepted to the block, everybody has to sort of validate it and run it. But people are kind of leery about taking anything that doesn't follow the standard template. Okay. Now, I'll come back to this a bit later because this is one of those areas that Bitcoin sort of touched on something that's very powerful and didn't quite realize what they had hit on. So there's other cryptocurrencies that have really pushed this as far as it can possibly go, and we'll come to those. Now, this was sort of the early version of how things were supposed to be in Bitcoin, and where it's gone have been a bit different. So I'm going to share my screen again. And this will get a little bit to your question, Kareem, about sort of libertarian views. Early on, this was intended to be a Bitcoin mining rig. You'd have your laptop, or maybe you have an old desktop machine in the corner. And when it first came out, you could just have it running the Bitcoin mining software and you'd make some money for yourself. I'm sure all of us wish we'd go back in time to 2009, take whatever computers we had and basically mint ourselves a new house. Things have changed. So what you see, this is the hash rate from 2009 to 2015. And you see right around 2014, things start to really spike. And what you see happening is that some real economies of scale take over. And the idea that you could actually mine Bitcoin on your laptop today is laughable. There's just no way. All the computers that you could find that, that are just normal laptops, normal desktops, are never going to find a proof. Instead, today, this is what we think of when we look at Bitcoin mining rigs. Very specialized machines. You can even find server farms where there's racks and racks of these machines. Now, the early sort of versions of these specialized machines were what they call GPU miners. And they were these GPUs, for those who are not familiar with the term, these are the stuff that if you want really good graphics on your machine, the stuff that video gamers are go nuts about. and they're really good at doing these type of calculations that Bitcoin needs. And then they became outdated as people came up with what they call Asic miners, application-specific integrated circuits. So these are machines that do nothing but mine Bitcoin or some related cryptocurrencies. They aren't good for anything else. They're expensive, and they use up a lot of electricity. So it really changed the nature of what a Bitcoin miner was, in that once upon a time, it really had this libertarian idea, basically the idea that trying to be independent from the government, trying to create that nobody can shut things down, that we're all able to run this and freedom on the web type idea. And then today, it's dominated by people who are investors. They've spent some money on the equipment, they're spending money on electricity, and they want some return for their investment. So that means they want things like steady payouts. And because of the really irregular nature of Bitcoin, that was kind of a problem. It's sort of like if you tried to have an investment plan where you go down to the 7-Eleven and buy a bunch of lotto tickets. You might make a profit, but there's probably a lot of times you're going to go broke. So the way they solved this problem was by creating mining pools. It's sort of like, we all decide to buy a bunch of lotto tickets together, and then we split the rewards for whatever tickets happen to win. Now, unlike playing the lotto, you will tend to make some money out of this. It's a pretty well-paying lotto. But the problem with that is this whole idea of having a very decentralized cryptocurrency that's running on everybody's laptop in the world, and no government can shut down, has changed into something where really just a few people who control these mining pools control the entire network. So the fundamental thing that was really interesting and special about Bitcoin has kind of gone away. The whole idea that nobody's in control, that just isn't true as much anymore. Okay, Kareem, did that kind of touch on your question enough about the libertarian aspect of cryptocurrency space?
It does, and it raises several more. So if you then look at what the situation is in today's terms, if it's not libertarian anymore and it's controlled by money, if it's controlled by money, then that's exactly what this environment today is, politics and government. I mean, that's who control things. And now it's the same factor. So have we actually just given up, thought we had control and given it up again to a different set of people?
Pretty much. I mean, what is maybe a little bit different is that if you happen to be an independent mining rig operator, this is the kind of thing college students love to do: buy a mining rig and use dormitory power. You join a mining pool, but if you don't like what that mining pool is doing, you can always jump ship and go to another mining pool. So there's at least a little bit of flexibility in voting, so to speak, that happens. But yeah, it is still kind of about investors and money. It's just maybe there's a little more hands-on and activity for the investors than it might be typical in other situations. And that is sort of one direction that some of these cryptocurrencies have gone, of ways of trying to sort of, can they return to these libertarian ideals of not letting anybody really control how things work?
So no, thanks for that. So then do we then go towards any environment that we've seen happen in the past, whereby a rogue government or political environment can take control of this to a certain extent? Because if you start to look at the trade imbalances that were created early on, it was by governments who didn't have controls in pollution and working wages. So if we look at this, if it takes power, which costs money, and you've got a rogue government that says, you know what, you can use all the hydroelectric power I have to create Bitcoin, does that create a skew towards those countries? I mean, these are just,
I don't know. I mean, it's probably a little bit beyond my domain expertise, but it would seem like, it is easy to sort of move the centers of mining power around between different countries. So if you had some country that was offering cheap electricity, say, because they wanted control of this network, that could be a possibility. As long as the physical machines aren't located in that country, though, it's still possible to sort of bounce around pretty easily. So the moment people start doing things that isn't popular, unless those machines are physically located in that country, they still kind of have limited control of what they could do. And the libertarian streak isn't totally dead in the Bitcoin world. There's still a strong contingent that has those ideals that would, including the miners, that might jump ship if they started seeing things happen they didn't like. But it has gone quite a bit more towards the investor perspective.
So then a loaded question then, why then do you think in the last 60 days we've seen Bitcoin go from $10,000 to $17,000? I mean, I just don't understand that sort of momentum.
On that one, I think you'd have to ask an economist. I have no idea why some of the things happen that do.
Who out there in the panel it knows anything about this? It's just like, this is so strange. Okay, Tom, you're still on then, it looks
sure.
like.
So Hector, you'd asked a question about, is a 51% attack possible? There is a certain amount of concern about, with somebody just having total control of the mining power, could something weird start happening? Some mining pools have actually gotten larger than 50% for short periods of time. Usually it doesn't last too long because everybody gets nervous about it. And you still have the independent miners that are going to see the transaction. So you sort of have to have all of them okay with it, or maybe just not paying that close attention to what happens. It's not impossible. It's way more of a risk today than it used to be. I had something else I was thinking of in that direction, but I forget. Oh, and actually 51% is kind of optimistic. There's some attacks out there that actually can work with a smaller chunk of the network. So there was some large mining pools can do attacks where they could sort of get more than their fair share. So far, everybody seems to be playing fair and nice because everybody's worried about retaliation, and all these heavy investors that have invested all these expensive machines into this network don't want to do anything that makes people uncomfortable about that network. So is a 51% attack possible, or something similar? Yes. Do I think it's going to happen? No. I don't see it happening because the people will lose out too much.
Thank you.
Sure. Okay, let's see. What is the self-corrective process in the blockchain that could prevent this? I think the real trick is sort of one area that I'm very interested in is, could we restructure these incentive mechanisms in a way that would make mining pools less attractive? And there's been some research in this direction. I've done some research in this direction. If we can set up a payment so you don't have to be part of a mining pool to make a profit, then all the incentives to, form these big coalitions goes away. So there's been a few people trying to go in this direction. There's something called P2 pool, which is designed to create a mining pool that itself was decentralized. And it was a really cool idea and had some buy-in. It unfortunately just didn't work and was never competitive with the major mining pools. So I think they finally shut it down. Too bad. Oh well, hopefully somebody will come up with a better solution there. So some of the other, there's some other problems with Bitcoins that have come up with either flaws, and I hate to say flaws in its design, but maybe places in its design that are not ideal, or things that could have been made better, or just new opportunities that people saw and that wasn't what Bitcoin didn't quite capitalize on. Is it possible for the market to be cornered on the way silver was? I'm not sure, and I don't remember enough about how silver was cornered by the Hunt brothers, so I'd probably have to defer to somebody else on the panel to answer that question. Let's see. So one of the issues that I think has been some additional problems besides just this increasing centralization is the fact that the network for Bitcoin is kind of slow. So it takes, there's a limited size of blocks that can only take so many transactions, and you only get one every 10 minutes, and that's hardwired into the protocol. If the network starts getting faster, they make the puzzle more difficult. So basically, if people are able to solve the Sudoku puzzle in 20 minutes instead of 10, they make the puzzle that much bigger, so they expect it'll take you 10 minutes again. And then you're supposed to wait for 6 blocks before you're really supposed to be able to trust that these transactions are confirmed. So we're talking about an hour once you can convince some of the miners to take your transaction before you can really trust that money has changed hands. Now, if you go to a coffee shop and you want to pay for a cup of coffee with Bitcoin, it's sort of awkward if they say, okay, great, why don't you sit down there and in an hour, once it clears, we'll bring you your cup of coffee. So people have had a lot of different systems of ways of trying to kind of either work on the edges of Bitcoin, and then there's been some cryptocurrencies that just try to speed things up. So Litecoin, for instance, came out, and really their only contribution was that they made the proof of work a lot simpler. Something, you know, computer science dude could probably do in half an hour. And yeah, it's been pretty successful and gets much more feedback and is, you know, at least one reasonably well-known cryptocurrency. Yeah, XRP. Well, what happens after the last Bitcoin is mined? That's a question. That's a good question. And we notice that the network, the mining power takes a hit every time the mining power, the mining reward drops down. So periodically, though it works, every so often, I think what they have the reward amounts, and eventually they're going to reduce it to zero. And at that point, it's supposed to be based on nothing but transaction fees. And there's a lot of concern about what happens next. So are the miners still going to behave in the same way? And these are questions nobody really seems to be totally sure on the answers yet. Yeah, so time will tell. Another issue that people have complained about is, you know, how much electricity Bitcoin uses, and it's not really good for anything, like other than validating Bitcoin transactions. So is there some way we could take that work and try to repurpose it? So I sort of hinted at this a bit earlier when I talked about one of my students making a Sudoku solver based on this. But there are some other interesting ones out there. You might have heard of Primecoin. And Primecoin basically swapped out the Bitcoin proof mechanism to search for prime numbers. And the way they have it set up, it's comparatively easy to verify that somebody's found some prime numbers, but it's very difficult to actually find these prime numbers. And the benefit there is that we get something useful for all this work that's being produced. So, and there are other more opportunities for that. Can we create coins that actually do something valuable for the world? Or if not valuable for the world, valuable for individual users. So I have a student for a thesis project is trying to make a bioinformatics blockchain where the miners will actually end up doing multiple sequence alignment of DNA sequences. And then in addition to validating these transactions, we actually do something that's, you know, producing knowledge for the world. Other people have discussed things about SETI at home and how maybe this would be useful there as well. So that's been one sort of branch of work. Can we sort of repurpose this computational work to do something valuable? And then people looked at what other resources can we use besides electricity? Can we do something that's maybe not quite so bad for the environment? So a few have looked at using storage. And the idea there is maybe instead of storing a bunch of junk data or doing a bunch of junk calculations, we can store stuff on our hard drives, and that will sort of take the place of the Bitcoin proof mechanism. So one of the early examples of that was called Permacoin. And Permacoin, the mining network was storing the Library of Congress. And, you know, part of what you had to do is they had some proof of work mechanism as well, you know, some computational work required. But in addition to showing that they'd done this computational work, they also had to show that they were storing part of the Library of Congress. And this sort of combination is reducing the load on the amount of electricity required in exchange for providing some useful service to the world. And then there's others out there that have tried to make this a little more valuable. So there are some versions also that do, they're storing sort of junk data, kind of like Bitcoin does junk calculations. Nobody cares about this data, but the idea is that then you can use old hard drives, and maybe that would be better for the environment than burning up using a bunch of electricity. This also kind of gets back to those libertarian ideals again. Some of the proof of storage protocols argue that this would be a way that would be harder or easier for anybody to participate to do something useful. Now, I don't know if that's true or not. None of those currencies have been successful enough to really give the incentive for these hardware designers to build specialized machines for us to find out. But at least it's a possibility. There might be some way that we could build a network so that it wasn't just controlled by these few big players. And then the one that you probably hear about the most, I'm guessing probably most people at least heard the term in passing, is proof of stake. Has most people heard a little bit about that?
Maybe just to clarify the exactly what it is compared to proof of work would help.
Yeah, so the idea of proof of stake is that instead of tying it to computational power or storage or something like that, you tie it to the amount of money you have. And the idea basically boils down to, if you have a whole lot of Bitcoin, say, you're not going to burn down the Bitcoin network because then your Bitcoin isn't worth anything. Now, there's a whole lot of different forms for how this works. Some of them came on early on, and they're like PureCoin was the first one I'm familiar with, and their idea was, well, you still have to do the computational work, but if you have a bunch of money, we'll make your computational work easier than other people's, and therefore it's sort of cheaper and less environmental problems to do that. And we trust you because you're really going to lose out if all your money goes away. And then the one that came out, I think, really put the idea in everybody's head was Tendermint. We had probably a lot of people have heard of Cosmos. Is that a familiar name? Yeah, so Tendermint, Cosmos is for the name they're pitching more today, but their back end, really consensus mechanism is the Tendermint protocol. And that is designed to try to take advantage of some of this computer science research and trying to provide consensus and work that into a blockchain instead of the proof of work. So they don't need as much of the computational power, but they send an awful lot of messages back and forth on the network. So it has some benefits, but it also kind of limits how many people you can have involved because there's just so much network traffic to go around. And the more people you add, the more complex that gets. Oh, Tony, I think I missed your question. You asked who gets to put, if we have these transaction fees, who gets to put the transactions in the block? The mechanism will mostly still work the same. Basically, whoever, and even today, miners get rewarded with transaction fees and the mining reward. It just happens to be that the mining reward, that those coins that come out of nowhere tend to be the lion's share of the profit for the miners. The transaction fees, though, are also included. So those rewards go to whoever the miner who finds the proof decides they go to. Now, typically, this will be a case that it's by a mining pool who will then divvy it out to their supporters based on how much each person happened to help them in building this block.
So this raises an interesting question that we've heard, as it was pointed out, that eventually you get to the end where there is no more Bitcoin that are being mined. The algorithm has run out, if you will, and so that's the limited supply. It's I suppose, think of it a bit like, I suppose, gold. If all the gold mines ran dry, but what about all of these other coins, other currencies like Ethereum or some of the even XRP? I mean, are we saying that all of those will also, that their algorithms also run out and there's a cap?
Some yes, some no, and it's always will be specified by the protocol. So I believe Ethereum has a total cap as well, and other protocols don't, and they're going to have inflation forever, and that's what they've committed to. They're just a set rate of, they're going to produce this amount of reward for blocks forever. Yeah,
and it ends up being an endless inflation for those ones.
Inflation, and I don't know. My own sort of instinct on that is that's probably the way to go, just because sort of we understand that problem in the cryptocurrency space. We're not as sure what happens when everybody runs out of money, or when the system runs out of money and all that's in play. So, yeah, there is differences in systems and how they're designed. It's not totally clear which approach is better. I have my own bias, but other people disagree with me. For whatever reason, the libertarian crowd that we talked about before, they always tend to be pretty convinced that there should be a finite cap. These are the same people who also invest heavily in gold in the real world too. So maybe there's a certain parallel there. Let's see some questions I haven't got to. Fair to characterize Bitcoin as nothing more than a store of value that is paving the way for other crypto projects? Maybe, but there's a lot of weight behind Bitcoin just because it was first and has the biggest mind share. I think it would take something that had really great benefit over Bitcoin to displace it. And so far, I'm not sure that that's really come about. One of them that's probably worth discussing a bit is kind of the last piece I had as sort of the plan thing to mention was Ethereum. So when Bitcoin had a scripting language, it was pretty locked down, but people started seeing a whole lot of potential in the way that things could go, that this is really a system where the scripting language could be made to do just about anything you wanted, anything a desktop application wanted. So the way they do that is a bit more complicated, but they basically make you pay for computational steps. Like they call it gas. So you buy a bunch of gas, and if you run out of gas, that's your problem. They take your money and they put you back to where they roll everything back. So the universe reverts to its previous state, except that all your money is gone. The trick there is every single machine on the network has to come to the exact same point. So that's why they have this big complicated infrastructure. And then sort of their proof of concept, which sounds kind of goofy, but really does show how flexible it is CryptoKitties. Has people heard of that? Remember Tamagotchi pets a long time ago? So basically CryptoKitties was Tamagotchi pets on blockchain. And you could feed your pet with Ethereum and things like that. And yeah, this brought the Ethereum network to its knees for a while because the miners couldn't keep up with the people playing with their CryptoKitties. But it really does show the flexibility and power of what they could do, and has then since become sort of the gold standard that people have followed for trying to get a really flexible, powerful blockchain that can be used more than just as a currency, but actually as a tool to build some interesting applications. And that gets to, you probably heard a little about people in passing talking about Web 3.0. And this is as marketing buzzword heavy as Web 2.0. As much as I can figure out, the basic idea is that Web 1.0 was supposed to be everything centralized. You know, for instance, the Mercury News would be a good example. That was the first newspaper online. The data comes from them. The application comes from them. And they control everything. And then things like Facebook and Reddit came out. So this is really what they start referring to the Web 2.0, where Facebook and Reddit can control all the software and the applications. But all that data really comes from the users. If all Facebook users suddenly abandon it, Facebook dies despite everything that they've got built up. So, and then in contrast, Web 3.0 is supposed to take that logical step of making everything decentralized. So you can see the power of how that would be to create, say, a news application where you could post sites that is going to be running on every machine in the world in theory, so that no network would be able to really shut it down because it's everywhere. It's ubiquitous. There is nobody in control of it. There's nobody lawyers can approach. It's just part of the network. So that's part of the dream of what people talk about with Web 3.0. There's kind of a limited number of applications where that's applicable. I mean, developing Ethereum dApps is complicated and difficult compared to creating centralized apps. But if you need it, if you really need that sort of resilience against any type of censorship or against any type of thing that might take down your application, it's sort of a powerful model.
That actually leads to a question that came up a little earlier, and that I think we might have glossed over. It's from Siraj asking about what's the background for the urgency in bringing some regulation to the crypto space. So we hear about these various authorities, government authorities, looking to manage or control in various ways. I wonder, is that also probably it plays a role here.
Yeah, I think it's getting into some political issues that are beyond my expertise, so I may not be the best person to answer it, but I don't see a particular reason why it would be urgent now. But I think the thing that makes a lot of governments uncomfortable is that the decentralized nature, where it's not something they can shut down very easily. So you can imagine a site that is critical of a government might not be popular with that government, and it's maybe uncomfortable for them if they can't take it down. Like if somebody makes an Ethereum dApp to criticize different organizations, say. And there's some nefarious purposes too, like how do you prevent money laundering and things like this? So the typical solution for that seems to be that the police just sort of wait at the edge of the system at the banks and exchanges, et cetera. So the moment you try to convert the Bitcoin to a real world asset, they're waiting for you. But it's still this sort of challenging problem. It's also interesting the domains that sometimes become popular. One of the real major places where Bitcoin's popular, Northern California pot growers.
Yes, of course.
Banks will take their money And there's also interesting things they can do with the wallets where they can actually store multiple different wallets based off of the same passphrase with different passwords. And that, you know, there's also a lot of bandits, et cetera, up in Northern California because it's such a cash heavy area. So if you get captured and somebody holds a gun to your head, you can give them your fake wallet that just maybe has a small amount of Bitcoin, hopefully enough to make them leave you alone. And then your real big pot of Bitcoin could be stored with the same phrase, but with a different password. So it's sort of interesting, some of the options and technical innovations there. Let's see, do we have any other questions I've missed or haven't really talked too much about?
That most recent one from Tony, is there possibly a world where the ledger is the only thing that exists in the world?
I think Bitcoin, I could see a time and a place where Bitcoin is the only proof of work ledger out there because it just has such weight. And there, you know, one of the things that's not totally understood yet is, does proof of work give us, you know, this whole, you have to do computational work to verify transactions. Does this give us something that we don't get with some of the proof of stake systems that have become more popular? But I think things like Ethereum, et cetera, and some of these other cryptocurrencies are offering some value and utility. I don't see them going away. I don't think Bitcoin, I think they're more than Bitcoin, and there's enough value there that people want to see those survive too. So I could see a lot of the cryptocurrencies out there dying. Time will tell. So I don't know, Tony, did I answer your question? I'm not sure.
So, Tom, thank you. This has been great. I think you've created a little bit more confusion than we were hoping you would. But, if there are anyone out there with questions, please feel free. We've got a few more minutes. In the meantime, I have one question for you. I as a professor in crypto and what you do today with your students, I'm wondering, what was the impetus? I mean, how did this whole business, how did you decide to start this course? Was there just a huge demand from students who wanted to learn? And what are they saying? And what are some of the most, perhaps craziest, out of the box sort of questions that your students may be asking you or trying or experimenting with?
I heard one just yesterday. I had students doing, I made them do a project pitch, like they were trying to sell to a bunch of investors their idea for a cryptocurrency, just to make them have some fun with their class projects. So they ended up, my personal favorite was Karen Coin. I don't know if you're familiar with that meme, but Karen is supposed to be this person who complains to the manager all the time. The idea is with Karen Coin, you give people coins if they're acting like complaining, you're being an obnoxious customer. And so you have a coin with negative value. So I thought that was kind of a fun one. And I don't know, one thing to your question, Kareem, I think one of the things that was sort of interesting to me is I got interested in it just because I thought it was a cool piece of technology. And then it sort of took off and I started, learning a little more about it. And then at some point it seemed like there was a big crash in the cryptocurrency space and a lot of the money was going away. And you would sort of expect the interest to die away too, but students were still interested and excited about what it was doing. So I think there's a certain cool new toy feel that engineers get sometimes of, hey, this is an interesting thing. Now there's actually I'm not sure if it's still active. There was a student club on campus called Block Legion, where they were just cryptocurrency enthusiasm students from computer science and software engineering. I think they are touched on some other departments too. Faculty really wasn't that heavily involved. As I recall, the students had to track down and tackle a faculty member to get them to agree to be the club's official advisor. But this is really was a student-led thing. So there was a lot of interest in it from the technical side of, ooh, this is cool. What kind of things can we do with it? We have the shiny new hammer. What can we smack with it?
And so the other one, it's like we've talked about how the development have gone from home-based computers to these vast mining farms. What do you think the effect will be of the Moore's law as it comes to exhibit its strength a little bit more over the next 2 or 3 years?
In terms of, you mean the computational work, or you mean
computational work? Yeah.
I don't know that computational limits are really the problem with Bitcoin. I think it just really Bitcoin is sort of limited by its design. Like even if you had sort of infinite, or you don't, not infinite, but even if you could roll back time to make it really easy to find a bunch of proofs, etc., the network just ratchets down to be slow again. So it doesn't seem like computational power is the problem. And it can go both ways. So if it starts getting easier to make blocks for Bitcoin, or excuse me, it starts getting too hard to make blocks for Bitcoin and it takes them too long to find it, they make things easier so that you can actually still get that same rate. So it seems to be something that's designed to adjust to the computational power that's available out there.
And so it's interesting, you say they and it adjusts. Who's they and how does it adjust? Is that
the protocol? Okay. It's hardwired into the way the roles are set up.
Okay.
Periodically they check and see, okay, how hard was it how are we doing in making blocks? And if we're making too many, they make things harder. And if we don't making enough, they slow things down or they make it easier.
Okay. Well, thank you so much. We have time for one or two more questions, and then we have to say goodbyes.
I see Suraj, you had a question about, is it true that crypto may be gold backed? I don't know of anyone that's backed by gold, but there's at least two that I'm aware of that are backed by something else. So there was one that was sort of interesting in Venezuela called I think it was called the Petrol or something like that. And every coin was backed by a barrel of Venezuelan crude. And then there was, what is it called? Now, Bitcoin something that it was basically every coin in this network was backed by a US dollar. There's a lot of suspicions that they don't really have enough dollars for their coin. Tether was the name of the currency. So Tether was supposed to be that every coin was tied to $1 in the real world, at least if you believe them, which a lot of people don't. But it sort of uses the standard that people trade back and forth when they want to convert things to dollars easily. Oh, USDT, that was the acronym, United States Dollar Tether.
Yeah, that sounds a little bit like the Libra, the Facebook coin, which was claimed to be backed by a basket of actual fiat currencies that they would acquire each time they produced a Libra unit.
Yeah, and I've been wanting to learn more about Libra. I don't know that much about it. Some of the problem I have with some of these bigger cryptocurrencies from big companies is it's hard to get past a lot of the marketing technology to get down to the engineering level to see how it really works. And I've had that same problem with Ripple. The more I press into the details, the more marketing terms I figure out. I know some of the people who work on it, and there's some sharp guys there. But yeah, I haven't been able to really.
Yeah, it takes on the air of being something like frequent flyer miles and other sort of digital assets, so to speak, that are controlled essentially by a corporation or by a consortium.
Tom, thank you so much. The rest of you, thank you so much for being here today. It's been wonderful. Lily, did you and I learn something here today?
I thought I knew nothing before the part, but now I know less. So.
Thank you. I can answer any follow-up questions to the best of my ability. Paste my email in chat if anybody's curious. By the way, I should say that there's somebody at my university who has almost the same address as me, so if you email him, he won't know what you're talking about.
Yeah. We're going to be taking a break next week for Thanksgiving, so I hope you and your family enjoy the next week. Enjoy it with your friends. If it has to be on Zoom, enjoy some time with your family, whoever's in your house, and perhaps just be cognizant of keeping your distance and being safe. So we'll be taking a break next week. We'll be back the following week, the week of December, and we have an interesting topic then. It'll be all in regards to how to identify and how to work with and how to invest in early stage startup companies. And we're going to be exploring that topic a little bit more in depth with some great people and companies. So hopefully you'll join December 2nd and spread the word for your friends to join us as well. Obviously, we still have on schedule the Global Investor Conference, which is happening December 8th and 9th.